All right, let's get right into it. We're going to tackle a huge question for anyone investing today. Can you actually get a steady, reliable paycheck from those high-flying but super volatile big tech stocks? We're going to figure that out by doing a deep dive into the JP Morgan Nasdaq Equity Premium Income ETF, or as you probably know it, JEPQ. This is the fundamental problem, right? You've got the Nasdaq 100. It's packed with world-changing, innovative companies that have incredible growth potential. But man, it is a roller coaster. And most of these companies, they don't pay dividends. So the question is, how do you take all that growth and volatility and somehow turn it into a predictable income stream? Well, that's exactly the puzzle JEPQ was built to solve. So here's how we're going to break it all down. First, we'll lay out what we mean by the Nasdaq income puzzle. Then we'll look at JEPQ's really interesting two-engine approach. After that, we're going to pop the hood on the income machine itself, talk about the absolutely crucial trade-off between growth and income, and then finally, we'll figure out who this fund might actually be for. Okay, let's start with the big picture, the Nasdaq income puzzle. This is all about the natural tension between wanting massive growth and needing steady cash flow. This slide lays it out perfectly. On one side, you have the Nasdaq 100. It offers you a piece of the most innovative companies on the planet, but it comes with a price tag, a ton of volatility. On the other side, you have what a lot of investors actually need, especially as they get older, a consistent income check, less risk, and yeah, still some growth. As you can see, those two lists, they don't really line up, do they? And that brings us to JEPQ's solution. The best way to think about it is like a hybrid vehicle with a two-engine approach. It's specifically designed to bolt that Nasdaq growth together with some serious income generation. Let's look at the fund's official goal right out of its own legal filings. It's trying to seek current income while maintaining prospects for capital appreciation. That word maintaining is so important. It tells you that income is the number one priority, but the goal is to get that income without completely giving up on future growth. So here's how JEPQ actually tries to do both things at once. Engine number one is all about growth. It invests directly in a big chunk of Nasdaq 100 stocks to make sure you're capturing that tech upside. But then you have engine number two, the income engine. This is where it gets interesting. It uses up to 20% of its money to invest in these special things called equity-linked notes, or ELNs, and their whole job is to generate that monthly income and smooth out the ride. All right, so let's get under the hood of that income engine. These ELNs sound complicated, so how do they actually create a steady stream of cash for you? So what exactly is an equity-linked note? You can think of it like a custom-built financial product usually issued by a big bank. Its return isn't a fixed interest rate like a normal bond. Instead, its performance is directly tied to an index, in this case, the Nasdaq 100. For JPQ, these things are the absolute heart of the strategy for both generating income and trying to calm down that volatility. Let's break down how this actually works. It's really a three-step dance. Step one, the fund owns a bunch of Nasdaq stocks. Pretty simple. Step two is where the magic happens. Through those ELNs, the fund sells something called call options. Now, the easiest way to think about this is that they are literally renting out the potential for huge gains in the future. And then, step three, in exchange for agreeing to give up some of that massive future upside, the fund gets paid cash, right here, right now. These cash payments are called premiums, and it's those premiums that get passed along to you, the shareholder, as that monthly paycheck. But, and I can't stress this enough, this is the most important part of this whole explainer, that income doesn't come for free. There is a fundamental trade-off baked into the very DNA of this ETF. So let's be crystal clear about what you gain and what you're forced to give up. Hey, you don't have to take my word for it. The fund's own prospectus says it loud and clear. They state that their strategy will reduce the fund's ability to fully profit from potential increases in the value of its equity portfolio. That's it, right there. That is the deal you are making when you invest in this. And this chart shows you exactly what that looks like in the real world. Imagine a fantastic year, a roaring bull market. The Nasdaq 100 might shoot for the moon. Now, JPQ will go up too, for sure, but its gains are going to be more modest. Why? Because it already sold or rented out that explosive potential in exchange for that steady income. Its gains are effectively capped compared to just owning the index itself. So let's just boil this all down to one single crucial sentence. You are making a deliberate choice. You exchange some potential for explosive, out-of-the-park growth for more consistent monthly income and lower day-to-day volatility. It's not about being better or worse. It's just about having a different goal. So that brings us to the final and maybe most important question. Who is this fund actually for? Let's quickly look at the official risks and then sketch out what the ideal investor for this kind of thing looks like. Now, the prospectus is very upfront about the risks. You've got your standard equity market risk. Stocks can go down. That's just how it is. Since it's focused so heavily on tech, you've got non-diversified risk and technology sector risk. And finally, because it's actively managed, there's a risk of high portfolio turnover, which can lead to higher costs and potentially higher taxes. You just have to go in with your eyes open. So, putting it all together, who might really like this strategy? Well, you might want to take a look at this if you're an investor who wants to generate regular income from your tech stocks, and at the same time, you'd like to dial down some of that crazy volatility in your portfolio. And on the flip side, who should probably just walk away? You might want to avoid a strategy like this if your number one absolute top priority is maximizing long-term growth. If you have decades to invest and you're willing to ride out the full roller coaster of the Nasdaq 100 to capture every last bit of potential upside, then capping those gains just wouldn't make any sense for you. And that really brings us to the final question, and it's one that only you can answer. Does sacrificing some of that potential high-octane growth in exchange for a steady paycheck, does that fit your personal investment philosophy? That is the core decision you're making with a fund like JPQ. Thanks for joining me.